Ladies and gentlemen, welcome to the official Imperial Advocates Podcast. Today we have a very special guest who is our finance specialist, Mr. Charles. How are we?
Good, thanks for Fahad. Very well, thank you.
Talk to me about yourself. Introduce yourself to the people that are listening.
Well, we've been around doing this for about 34 years, and you can't tell from my grey hair, but nonetheless, we've been enjoying the journey of helping out many clients over this past 34 years, as I mentioned. And obviously in the last couple of years, we've been very heavily involved in the NDIS space, actually. And we've seen a lot of clients have a lot of success in that area, and we're looking forward to helping out many more.
Charles, the way I want to structure the podcast today is initially ask you a couple of the most frequent asked questions by our clients, and then it just becomes much easier, and you can just
Yep.
Okay,
Not
awesome.
a problem.
So the first question that we have is, how does the financial structuring of NDIS investment properties differ from traditional real estate investments?
To be honest with you, they don't really differ that much. They become just takes longer to do them because of the complexity of the NDIS space, if you like. But most clients are either doing the loan, if you like, in their own personal name, or they're doing it in a company with a trust. But the time frame involved is longer purely because, unfortunately, there's only one lender in Australia that does them, and so that's our biggest hurdle.
Right. Okay. So normal real estate residential loans are exactly similar.
Pretty well the same. There's no real great difference from that point of view.
Okay. So in conclusion, NDIS investment properties are still considered to be residential properties.
It's considered as residential.
You don't need a commercial loan for that.
It's not commercial, it's a standard residential home. The only part of it that is considered to be commercial is actually the valuation. Valuations have to be done on a commercial long form. They take longer and they are more expensive. The client unfortunately needs to pay for it because that's the way it is. And that's purely because the rental yield is so high. They treat that part as being commercial, but not the property itself. It's still a residential home.
Okay. And obviously the reasons behind why these valuations are a little bit more expensive than normal one is because this particular financial institution that actually passes the loan actually calculates the rental income of an NDIS property.
Correct.
However, the top four banks, on the other hand, they don't consider the rental factors when it comes to.
No, they would treat it as a standard market rental.
Yeah.
And it might be 4 or 5% in the market, depending on where it is.
Yeah. Okay.
Correct.
Awesome. So just to give you that comparative in terms of numbers when it comes to rental income, if you're buying a property for $800,000, let's suppose in Melbourne West, if that's for $800,000, the bank, which is a normal bank, is going to consider the rental income as the average rental income of the particular area.
Correct.
Whereas an NDIS bank, which is
Well, we could use it that way. I mean, as I said, they're a non-bank, but they will actually look at the government website, the SDA calculator, and that's the figure they will use, less the management fee for calculating of servicing of debt.
And then does that mean, because of that strategy, does that mean that serviceability tends to be much higher than
Correct.
Okay.
Absolutely. Every day of the week.
Now we're going to move on to our second question. Our second question is, from a financial perspective, what are the crucial factors to consider when evaluating the potential profitability of NDIS investment properties?
Really, it would come down to, your most important part of it is when you're looking at, we always look at what we call cash on cash position for profitability, that being, how much is the rent going to be for that particular property? And we know that because it's done from the SDA government website calculator. And then what are the cash expenses? The cash expenses, well, that's pretty clear. Interest on the loan, because they're all the loans are principal interest, but the interest per se of that component. Then there's the rates, insurance, property management or maintenance. I mean, there's a management fee on all of the NDIS properties. We're aware of that.
Just to give you a bit of figure, it's about 12%, 12 to 15%.
That's correct. And then, so that then would give you your net cash position. But from a tax point of view, and each person goes and sees their own accountant, of course, and then discusses it, then the only other add, if you like, or benefit to the client is what's the depreciation aspect, which is a paper entry to minimise tax payment, if you like, on the positive cash flow, because all NDIS properties, positive cash flow, after you take into account the rent, all the cash expenses, depreciation, and tax, they're still going to be positively cash flowed every day of the week, all the time.
Charles, from a financial standpoint, let's suppose we have a prospect and he's considering his next investment opportunity, right? He's got two options in front of him. He's got the residential property and he's got an NDIS investment property. What are some of the positive and negatives? And I know this is a question not specifically for a financial broker like yourself, but because you've been in the industry for a very long time, and you own NDIS properties yourself. So why would someone consider an NDIS property over a residential property?
It's a simple answer to that one, and that's just pure cash flow driven. We've got a number of clients. I've got one, in fact, who's got two residential investment properties right now in Bairnsdale. They are going to sell both those properties, cash out, because they're both negatively geared, and they're going to buy just one NDIS property, positive cash flow from day one. In actual fact, in their case, they're not going to have a loan. So it's all pure income. I have one other client, very similar, except that they sold two properties, and he's now in the process where he's purchased a house and land package, NDIS. It's going to be, there's going to be a loan, but it's going to be positive cash flow, which is what he was looking for. He was looking for something that would improve his cash flow position at the end of the day for the family.
Okay.
So it's chalk and cheese. It really is.
Yeah, okay. Charles, let's talk about a normal case study. Right? A client wants to purchase an NDIS investment property. How does the loan structure work? How does the finances work? What are some complications? And how can we help them?
Okay, so if we break it down, there are two parts to it. If, say, the prospective client is salaried, PAYG, that's a pretty straight up situation where they've got pay slips. They may or may not have other investment properties. In fact, we were talking to a client before. The questions we would always ask is, okay, what's your current gross annual salary, not including super? What's your family structure? Do you have any children? Is your wife married? Is she going to be part of the purchase? Does she have an income, for example? Then we would say, okay, what's the next step? What's your current mortgage payments? Who's it with, etc. Because if they don't have cash, but we need to restructure to take out money out of the equity of their home, so long as they've got it, we assess that from a financial position anyway. That means that we can then create the deposit from equity and we can keep moving forward. But we would ask them other questions like, do they have any other debts, credit cards, personal loans that we need to look at, making sure that we can add that into the overall financial position, as well as children, because all servicing is done on the basis of the number of heads in a house or under that roof. So we've got to look at that side of it. And then if they've got any other mortgages, we need to look at all of those things. Rental income as well. Then
what's a good case scenario for someone who could possibly qualify? I know it's a pretty
broad
question, but what's a good case scenario? Someone who's earning a combined annual income of?
Probably, I would think somewhere at least 150 per year. Good equity, in other words, where their loan to value ratio was, or we would term in the industry LVR, is probably somewhere around 60 or 70% tops, absolute tops for 70%, where we can utilise equity to help them to move forward. And where, of course, they've got reasonably good credit. That's an important one from our perspective. Their credit score would want to be probably around the 700 at least, from an Equifax perspective, to make it simpler to get through from. And we're talking on a salaried person, a PAYG. Self-employed are a little different.
They're a bit different.
It's a bit more complex, but nonetheless, similar thing, except we need more details of their company and tax returns and so forth.
Of course. Okay, awesome. Now, obviously, Charles, this investment property is not like a normal property, right? This is an NDI specific property.
Sure.
And you mentioned previously that we go to qualified banks, that ones that actually value the property accordingly to the rental appraisal.
Right. Exactly.
In terms of the interest rates, is that a big differentiation? Is it an expensive loan to do, or?
It is a bit more expensive to a couple of parts. One is the interest rate will tend to be higher because of the nature of the loan, if you like. That's part one. Part two is like the valuation we spoke about a little earlier. Because it's a commercial long form valuations, the valuations are generally somewhere between $3,000 to $4,000 per valuation, as compared to a standard residential rental where the valuation is anywhere from say $275 to say $330. Big difference, but all these items are tax deductible anyway to the investor. Then there's because the lender is a non-bank, Once you go over, well, all their loans are what they call self-insured. They insure them themselves. There's a risk fee for every loan, and it's percentage based on the loan-to-value ratio. So when you go to, I think 90% as an example, all loans that are over 80% with any bank, financial institution in Australia have mortgage insurance. Theirs, as I said, is a risk fee. I think it's 3.5% at 90% of the loan amount. So it is expensive.
Okay.
But there's always a cost based on, well, okay, the expense of that property might be it's cost me $20,000 in risk fee, but I'm making $160,000 or $180,000. So
exactly, yeah.
It's mitigated from that point of view.
100%.
So yes, they are more expensive, but from a long-term perspective, the client's well in front all the time.
Okay, awesome. In terms of the interest rates, what's that like?
Interest rates at 80%.
Right now specifically?
80%, 7.03 off the top of my head. 90% goes to, I think, 7.9. So it is expensive compared to doing a standard residential investment property loan, which is in the sixes, high sixes. So there's about a 1% differential. Okay. But that 1% again is mitigated because the rent is that much higher.
Yeah, 100%. Awesome. Charles, to finish off the podcast, what other consideration does someone that's looking to purchase an NDIS investment property might consider? How much cash, for example, how much cash do they need?
Okay, so we can't get to the exact dollar term, but to give you an indication, we always take into account, well, okay, worst case scenario, they need 10% deposit, worst case, okay. We try to aim for 80 because it's a lower rate of interest, but so you need the deposit. We need to take into account what's the stamp duty on the block of land going to be at that time. And if it's a $300,000 block, it might be about $12,000. So we've got to cover off on the stamp duty. We want to cover off on the risk fee. Then there's the lender's loan application fee, valuation fee, and all those things. The other thing that's really, really important here is we try to, and this is something that we've done from day one, is because there is a time frame in construction, they've got to fund each stage of the loan during construction for paying the interest only during that period of time.
There's a buffer.
So we create a buffer. So they've got sufficient, usually around 40,000 all up as a buffer, which should be more than enough until the house is completed and
the rental income's coming in.
Participants are in and the income's coming in. Because we don't want clients tipping into their back pocket.
Exactly, yeah.
Last thing in there, they're stressed.
Yeah.
We don't want that. So we always look at that. And the only way we can build all that money together is they've either got some cash over here or we're taking a combination of cash and equity. And it works every time, doing it that way.
Awesome. Charles, thank you so much for taking out your time and having this short podcast with me. And if you guys have any other questions, feel free to give us a call, write up us an email, or speak to any of our team members, including Charles.
Fantastic. I really appreciate it. Thanks a lot.